In this video, I'm going to explain the repo market, and we are going to discover if the recent chaos in the repo market is signaling the next financial collapse. My name is George Gammon, and this channel is all about helping you build wealth and thrive in a world of out-of-control central banks and big governments. So hit that subscribe button right now, hit the notification bell so you never miss a thing. First, let's figure out how the repo market actually works. This green circle is our repo market, and on the left-hand side, we have money market funds. They're the guys with all the cash. And on the right-hand side, we've got people like hedge funds, Wall Street traders, and the majority of this group are banks like Wells Fargo and B of A. And they have a lot of collateral, usually in the form of treasuries. Remember that the banks have reserve requirements, meaning by law they have to have a specific amount of cash on hand at all times. We call this a liquidity coverage ratio. So what will happen if these guys need cash, they'll put it out there in the market and they'll go ahead and trade the collateral for the cash. So let's say we've got Wells Fargo. They're a little low, so they'll take their treasuries and say, hey, money market fund, we'll give you our treasuries for the night. And the money market will say, okay, well, at a certain price, we can do that. We'll give you this cash. And the very next day, these banks give the money market funds their money back with that small bit of interest. The money market funds give the collateral back to Wells Fargo. Generally, these contracts are between 1 and 14 days, but they can last as long as 1 month. Number two, what was the problem? How did all of this chaos regarding the repo market originate? Well, we've got a chart right here, and it goes from 2% up to 10%, and this is the amount of interest that the repo market is charging. That's the going rate, and this is an annual rate. We start here September 3rd, we go to September 18th. Starts off along, nothing's happening here, nothing to see, don't worry about this, just business as usual. And then all of a sudden we get to about the 15th to the 16th and it just spikes, boom, straight up. And this is incredibly unusual. We go up to 6%, it goes back down a little bit, and then it spikes all the way up to 10%. So what was happening here and why these rates spiked up is because the banks had this collateral. Remember, they had the treasuries, and right about here, or on the 13th, everything's good to go. Everything's copacetic. The money markets are giving the banks the cash for the bonds. Everyone's happy. Then all of a sudden, around the 15th, when rates spike to 6%, some of these banks said, okay, guys, we need cash. We need cash. And the money market guys said, no, I don't think so. And the banks were like, wait a minute. We have to have this cash. Okay, fine. We'll give you 3%. And the money market guys said, yeah, I don't think so. Okay, fine, we'll give you 5%. No, I don't think so. 6%? And they said, okay, fine, we'll go ahead and do the transaction. And then what happened the very next day, or maybe it was the same day or a couple days after, is they had this exact same problem where the money market funds didn't want these bonds, or they didn't have enough cash. One of those two happened, and the rate spiked way up here to 10%. And then the Fed came in, they saw this emergency situation, and they printed up a ton of money like they always do, and they went right into this repo market. So now we've got the Fed. They print this money, inject it into the repo market. So now the money market funds don't have to provide this cash. They can go ahead and do this, they meaning the Fed, can do this swap with the banks for their collateral, and all of a sudden the rates go all the way back down to 0 and then pop back up to where they normally were at 2%. Number three, mainstream explanation. So what were they saying in the mainstream media, and did it make sense? Their first excuse was, well, it was just the time of the year. There were all these tax payments due, meaning that the banks have all this cash on hand, and the poor taxpayer here, you can see he's very bummed out. Well, he's got to pay his taxes, so he needs cash to give to the IRS. So he needs to get his cash from the bank to give to the IRS. That was explanation number one. Explanation number two was the liquidity coverage ratio. This was a new rule that was implemented post-financial crisis 2009. by Uncle Sam, the federal government, where they came into the banks and said, okay guys, the amount of cash that you have to have on reserve, it needs to increase to make sure something like the financial crisis doesn't happen again. Of course, as always, these politicians don't understand the unintended consequences. Number three, there are just flat out more bonds. The US is the largest debtor nation in the history of the world, and recently our annual deficits have gone through the roof. We are running $1 trillion plus deficits. In order to fund these deficits, the US government has to issue bonds. Well, if there's more bonds in the system, there's less cash in the system because you need cash to buy those bonds. So the third explanation is that, well, the government issues more bonds, the banks buy those bonds, they have less cash on hand, so there's less cash in the system as a whole. Let's go ahead and debunk these theories right now, and it's shockingly easy to do so. First of all, the time of the year with the tax payments, doesn't this happen every year? Yeah, it does. So why would this year be any different than the past year or the year prior to that? That doesn't make any sense. The liquidity coverage ratio. Okay, well, is this the first year that they implemented these liquidity coverage ratios? No. It was the exact same thing in 2018, 2017, 2016. So there's nothing out of the ordinary with the liquidity coverage ratios. Well, more bonds. Okay, again, same thing. Is this new? Did the US government just start to issue more bonds as of September 15th? No, of course not. They've been running up all of this debt with these massive deficits for the past 10 years. The bottom line is none of this makes sense, and there's got to be a better explanation. Number four, what is my explanation using good old-fashioned common sense? I want to point out that the banks lend into the repo market just like the money market funds do. I just didn't include that in the last segments because I didn't want things to get confusing. So one night, a bank can be the lender of cash if they have excess reserves, and the very next day, that same bank could be a borrower if they need more reserves. So in this example, we're using the usual suspects here: Citi, HSBC, Deutsche Bank, Wells Fargo, Goldman Sachs, and Barclays. So the first thing, just using common sense here, that could be going wrong is the collateral is bad. So if Barclays has bonds that they want to throw out into the market, Deutsche Bank might be hesitant if those bonds, if they don't have a lot of confidence in those bonds, they might go bad overnight. Well, that's not really going to happen with the US Treasuries. Now, it might happen with the mortgage-backed securities, but they're a lot lower percentage of the overall market lately than these treasuries are. So that's probably not what's going on. Next, we have an increase in bonds or a decrease in cash. So if the normal market, it's kind of at an equilibrium, has this much cash and this much bonds, about the same here, well, what happens if the bonds dramatically increase or if the cash dramatically decreases? Well, we took care of that in our earlier explanation. It's probably not likely that the bonds just dramatically increased overnight. Now, over time they probably did, but not just bam, right on September 15th. So is it possible for cash just overnight all of a sudden just to disappear? Well, let's get to that in a bit. Next, we got the solvency of the borrower. Maybe these banks know something that we don't about these banks, and they're like, wait a minute, I don't even trust the solvency of these banks overnight. I don't trust them enough to give them cash. And if you think, well, George, that sounds crazy, let's remember in 2008 what happened to Lehman Brothers. They went bust literally overnight. So if these banks, or some of these banks, were having solvency issues, that would require the Fed to step in and inject cash liquidity into the repo market to cover their butts, because they know that if these banks go under, the whole economy has got huge problems. Oh, but wait, there is more. Remember about the decrease in cash that we were talking about earlier. What if one of the banks on this side of the equation was close to insolvent or on life support? They wouldn't have the cash to inject into the market. That would also cause the Fed to come in and paper over that problem, so we, the general public, didn't realize what was going on and we didn't panic. Remember, the economy is about debt, asset prices, and confidence. So if that confidence goes, the whole thing falls apart. And if you think that's totally improbable, I want you to check out a chart of Deutsche Bank, and you tell me whether or not this explanation is realistic. Now let me be clear, I'm not saying that this is for sure happening. I'm saying to me, this is what makes the most sense. For more information on the repo market, more specifically these mortgage-backed securities, check out this content right here, and I will see you on the next video.